Thanks for joining our webinar today. My name is Iqbal Brainch and I head up marketing and product strategy for OptionsCity. As you may know, OptionsCity is simplified the way clients think about and utilize trading technology. We've been in this space for 9 years now and have offices here in Chicago as well as New York and London. OptionsCity has taken a hybrid approach to software development, spanning the spectrum between building your own custom solution and buying an off-the-shelf solution. We believe this allows clients to have a quicker time to deployment while still maintaining the custom functionality they require. OptionsCity has become the leader in options on futures software across the major asset classes with 2 core product offerings. We offer City Trader, which we just announced this summer, which is a web-based platform for professional traders interested in trading futures as well as options on futures. And we have our flagship product, MetroNow. MetroNow is largely focused on market makers, proprietary trading firms, and institutional traders. The presentation today is largely geared toward users of our MetroNow platform. Today we are excited to talk about time-critical American options pricing. I have joining me today Dave Hrencecin, Head of Quantitative Analysis at OptionsCity, and Dave will be walking you through his thoughts on American option pricing models. We expect Dave's talk to last 30 minutes, and we'll leave plenty of time to answer questions which you can submit through the GoToWebinar. With that, I'll turn it over to Dave.
All right, thank you, Iqbal. So what we're going to cover today is an overview of some of the American option models that we provide, and in the context particularly for the model requirements for our users, and providing a high-level understanding of how these models are built and the trade-offs that might come into play. So we'll be going in particular talking about the WHALEY and the JU-ZHONG models, and we'll cap off with some model performance and comparison discussions. So in choosing an appropriate model, say I were a practitioner in enterprise risk management, I would be interested in particular to accurately capture as much of the market dynamics as possible using stochastic volatility models, Monte Carlo simulations, calculations that might actually take the span of a overnight run to get all the numbers that we need. But for our clients, say the market makers and the traders who are doing proprietary approaches to the markets, what's more important is the focus that's very localized and dependent on speed, edge, and the proprietary trading techniques. Accuracy is still important, but we need to have a fine balance in the trade-offs between those things. So we'll take a look at 2 of the fast pricing models that could fit the bill for market-making purposes. That's the WHALEY and the JU-ZHONG model, and we'll start with the basic building blocks. Most people are familiar with the Black-Scholes formula, and if you're not, it's all right. Basically, you can think of it as a black box. It has inputs of the underlying, the strike, the time to expiration, various different interest rates, the cost of carry, the rate that's the risk-free rate, and so on. Also a volatility input. Now, if we use this model, it provides us with a pricing and hedging performance, hedging calculations for European calls and puts. As it turns out, there are other options, the American options, and basically we can use a similar formula. We can use this same PDE, partial differential equation, to solve for American pricing options as well, and the approach for WHALEY is basically as follows. So we take the Black-Scholes formula and add to it a early exercise premium, which is another model that we add on top. And so since this early exercise premium is in fact a option or a contingent claim that also would solve Merton's equation, we can use a solution to this partial differential equation to get that early exercise. And the transformation that was used provides a partial differential equation, which in itself is rather complicated looking. But if you remember back in the day when we took differential equations, one of the first second-order partial differential equations that we learn how to solve is one of this form. So the WHALEY approximation assumes that this last term in the partial differential equation is 0, and that gives us the solution to that part that we boxed off, a solution of the form of a power function. Now this assumption is okay when you're dealing with short maturities because the option price is close to 0 and it doesn't really matter how H changes. There's not much that's going to happen to the option price, so the rate of change is close to 0. And for very long maturities, H is actually, from the prior page, 1 minus the discount factor. That's up here. And this is close to 0 when, well, 1 minus H is close to 0 when 1 minus the discount factor is very close to 1 for H. All right, so we have this solution form, and what we need to do is lock it down. We have rates of change, but we don't have some initial condition set in. And basically, in order to find a solution, we'll take the early exercise boundary, which is a critical underlying price, S star. And at that price, we know that if the underlying is, say, below that value or above that value, it's either better to hold the option or to go into early exercise and just exercise it. Now let's have a picture of that. So if you look on this left graph here, we've got the orange line here is a payoff for a call at 1500, and the Black-Scholes analytic formula in green, and then WHALEY as well, illustrating where this critical price is. So, sorry. The next graph on the right is taking the payoff out of the equation. So we're taking the Black-Scholes formula, we're taking WHALEY, and we're subtracting out this payoff, and we're left purely with volatility value. So the payoff is entirely 0 because there's no vol value in the payoff. The Black-Scholes analytic crosses early, and what's left is this difference. That's the early exercise premium. And there comes a point where the Black-Scholes formula plus the early exercise premium ends up being equal to 0, or rather the payoff when you're canceling out that. So the vol value is 0. That's the point we solve for, and typically with the analytic or pseudo-analytic form of WHALEY, we'll have to solve iteratively for a fixed point to find where that S star is. And then that S star is constant, and it's part of the solution. So we solve this equation. We get the WHALEY formula is the Black-Scholes formula plus a constant A, a constant lambda, a constant S star. It's basically a power function S to a lambda times some other constant terms. Now, let's look further at the JU-ZHONG approximation. They took a similar approach, starting with WHALEY, and then took not just the WHALEY PDE, but also the original form that WHALEY simplified. And basically adding to WHALEY, which is this G1, a second solution, which then as an approximation they scaled as some rough constant multiple of G1 and tried to fit it to this full equation as a correction. Now, basically we don't have to understand all of these formulas, but the key is to see that we're dealing with originally Black-Scholes, then we're adding to it an early exercise premium, and there's different forms of that formula that are involved. And in the case of JU-ZHONG, it's actually WHALEY with an additional multiple of extra terms. So now if we look at some spreads, we can get an idea of pricing performance and how the models behave over different sets of inputs. So in this graph, I have a comparison of WHALEY and JU-ZHONG also against a Black-Scholes tree calculated early exercise model where I've used, I think, 1,000 steps to try and get a good rough approximation for a benchmark. And if you look at this, we're at 10 days to expiration. We've got a 1% interest rate in place. I believe I'm using a zero carry, or rather the dividend is the same. So this is in the context of pricing of futures, and a 20 vol. And the JU-ZHONG model unfortunately has some issues with it. There are some instabilities that can occur, and we will delve into that a little deeper later. But basically, WHALEY performs better is in this time horizon. Then we go to about a half a year out with similar inputs, and now we can see the green curve, which is the JU-ZHONG model, starts. It's a closer fit to the red curve than WHALEY is. And further on, 2 years to expiration, now we're looking at a JU-ZHONG model that really does considerably better. And bear in mind that in all of these, we're looking at pricing a spread. And so that is going to magnify the errors, and it's going to give us a much better idea as to the price performance. All right. So what we have is a hybrid model that naturally comes out of this observation, where we might take an idea of using WHALEY when we have short-dated options, like, say, less than a month. And then when we're looking at longer, more intermediate to longer-dated terms, we'll use the JU-ZHONG model, let's say at 3/4 of a year. And anywhere in between a month to 3/4 of a year, we'll average by some weighting the results of both models, gradually shifting from WHALEY to JU-ZHONG. And that's a model that we also offer to our clients. So let's take a look at the performance and comparisons, and I'll also touch on another paper with a new model that was recommended. So as we can see here, we've got an underlying of 100, strike of 100, volatility of 34%, and the carry in our case, or the dividend, is 0. The carry is the interest rate. So we're not using a zero carry, we're using a zero dividend rate. And we see there's these areas of not so good performance where the JU-ZHONG model actually spikes and gives both positive and negative values. And a more dramatic situation that was mentioned in this risk paper that was published this summer, I'll mention again. This actually occurred with an underlying price of 27.955, a strike of 28, and a volatility of 34.16, priced on, I believe it was an equity, but I'm not entirely certain, where there was a bad price in a system and it led to a bad trade. So clearly there are problems that can occur with the JU-ZHONG model. Now, in the case of pricing on futures, we have done investigations of the model, and in general, I've found that empirically these problems occur when the time to expiration is very, very low, and or the combination of rate times time ends up being below a certain threshold. So you can see this instability area, but it's occurring in a very isolated region of the graph. And we've already taken that into account with our JU-ZHONG model and addressed that. So let's go look again at this first case and look at the hybrid the WHALEY and JU-ZHONG model and see how that smooths things out. It does a pretty good job. And the second case, which actually occurred in reality, in real life, in trading, we also have quite dramatically more of this instability region following this curve. And we apply the WHALEY-JU-ZHONG hybrid model, and there's still a problem area, but it's been greatly reduced. Now again, bearing in mind that this is when we're dealing with pricing of options, not necessarily on futures, which simplifies things for us. Then in the case of pricing on futures, we've got our adjustment to the JU-ZHONG model, and then when you take the hybrid model, basically it's virtually the same price altogether. Now let's go back and summarize. So for longer dated options, we would consider using JU-ZHONG, and for shorter dated options, we would consider using WHALEY, particularly because of the increased complexity in the model. And also, if you look at this term here, there's a 1 minus chi in the denominator, and this is where the problem actually arises. There's no guarantee that this chi expression is going to be far away from 1. And when it turns out that chi is close to 1, then we end up with a division by 0 and then the blow up in prices. Fortunately, it occurs in very isolated, hard to kind of find situations, and also fortunately we've found that in the case of pricing on futures that it can be generally alleviated, gotten rid of, okay, ameliorated. So the WHALEY-JU-ZHONG hybrid model automatically shifts regimes between these two cases, and we generally would only recommend using it for futures when the cost of carry is 0 and there's no dividends in play. Now back to the paper. There was a very, I think, exciting paper that was published in Risk magazine. The authors are listed up top. It was called American Options, Time Critical Pricing, and I'll put the URL on one of the later slides. The authors basically took the JU-ZHONG approach and extended it. They modified some of the shortcuts that were taken by JU-ZHONG, got rid of one, added another, and they claim via their empirical evidence that the instabilities that they demonstrated, that I've also showed you just now, don't occur in their new model. And so we will be looking into that if we have clients who would like us to implement that. And also in the paper they recommend, as we would, that the model should be used when calculation speed is more essential than accuracy. They also go forward and do some price and hedging performance, which I'll repeat using our implementations of some of the models. Basically, we run 2,000 different scenarios of combinations of underlying prices, strikes, time to expiration, and volatility, and group all of those in the all column here, which I've got in gray, and then look at, as a benchmark, a Black-Scholes tree with, say, 10,000 steps. This is an early exercise binomial tree, and it's fairly good in terms of scale. If we're looking at an error of scale in the order of the third decimal place, then comparing that to a tree with 10,000 steps is actually going to give a good idea as to how bad or how good the errors are. So if we look, for example, at WHALEY, we talked about the short dated, which is this darker green, and the longer dated options, which is the brighter green. And in WHALEY, it's pretty clear from this cross-section that the performance is really good for short dated and not so good for the long dated. We could be under 1/4 of a tick for the short dated options, but for the long dated options as much as maybe on average 1.5 ticks. And the JU-ZHONG model does a very good job of getting rid of that problem space. And so now we're ending up with the JU-ZHONG performing as well in the long-dated region that the WHALEY model performs in the short-dated region. Now, one other comment as well, the authors of the July risk paper take a look at the cross-section of random inputs that they used to generate 2,000 prices, also at the delta and at gamma. And I would like to sort of address a little bit of a maybe improvement to those results, and that is this. When we're using a model, we generally calibrate to the market prices. So to me, it makes a little less sense to think, I've got 20 vol, how close is WHALEY, how close is JU-ZHONG, how close is the hybrid model to exactly that number at that vol? Because in practice, we have a mid-market, and we're going to fit the model in between those prices, and the volatility that's used to get the right price for JU-ZHONG might not be the same vol that we'll use for WHALEY. And so in order to compare the other Greeks, gamma and delta, for example, what we first have to do is recalibrate our prices so that now we're locked in with the same implied vols that'll get the prices that our benchmark gets. And then take a look at delta with the recalibrated volatilities for each of those models, and roughly we get about the same delta hedging parameters performance. An error on the order of 0.5% in WHALEY, 0.25% in JU-ZHONG and WHALEY JU-ZHONG. More dramatic, though, would be in gamma, where the numbers don't look very good, but once we rescale our prices by changing the volatilities for each individual model, we end up with a much better performance in gamma. And so in general, I'd concur with the July risk paper that the WHALEY JU-ZHONG model, the JU-ZHONG model, that those models that we have in place for pricing options on futures are good candidates for use in a trading operation, and particularly for options on futures. So here's the papers I might point you to. The first one is the original WHALEY and Baron-Adesi paper, and the last one listed is the paper by Zhu and Shang, and the risk paper, American Options Time Critical Pricing, you can access if you have access to Risk Magazine's online content at this URL, and it's definitely recommended that you take a look at that paper. So if you have any questions, by all means you can submit them to the GoToWebinar. Let's see if we have any questions. Someone's asking if you trade short vol, would the hybrid model be more appropriate? I can't necessarily advise one model to another. What I can say is that if you calibrate a model and you're satisfied with the market dynamics for that model, and we generally demonstrated the performance and some of the trade-offs for those models, that what you want to do is look at, for example, how close do you need to be, how good do you want your hedging performance to be, and so on, and you basically have to make those decisions yourself. So I can't necessarily advise, except that we offer those models, and we've generally found them to be good for pricing options on futures. Okay, we will be posting this webinar. We have one person who's missed part of the content. Definitely, we're hoping to follow up with a blog on this and also a link to the recording. So if you've missed any content or you want to go over the slides and so on, we will be publishing that for you on our website. So by all means, take a look out for that. Okay, volatility inputs for for each model, they're just inputs, parameters for the model. We have a question, how are the volatility inputs determined for each model for the underlying? In other words, I guess it's not a complete question here. Okay, we'll wait for that question to finish. When using the hybrid approach specifically. Basically, the formulas that I listed before take a volatility input as it is in that formula. And so if you put in a 20 volatility, then it will be plugged into the formula, we'll solve for the critical point, and we will get values out of that model. There's no adjustments that occur. Right. And what I was commenting on the implied volatility is more from the perspective of when you have a model and you have a volatility input and the price of the option increases monotonically as you increase the volatility, then if you have a market price you're trying to match, then you can use an implied volatility technique to pull a vol out of the market. So the market has a 5.5 tick price for the option. In order to price the option at 5.5 ticks using the model, we use a implied volatility. I've got one other question that's very good, and I should have touched on that. The speed of the models, I didn't actually put benchmark times down, but basically if you look at WHALEY and you look at the JU-ZHONG model, those two models are very comparable in terms of speed. If you take the WHALEY JU-ZHONG model, it's probably about twice as long in terms of calculation speed, and that's because we're calculating both of those two models and then averaging them. The tree model ends up taking a little bit longer, and that's one of the trade-offs for using a pseudo-analytic model in the case of WHALEY and JU-ZHONG versus using a tree model like the BLACK-SCHOLES model. In order to get a decent speed from the tree, you have to really dial down the accuracy. And in order to actually get a benchmark price, for example, those 2,000 calculated option prices, the bulk of the time that it took for me to calculate was in calculating the benchmarks. 2,000 calculations on my sort of not super souped up workstation took about an hour and a half of calculation time, almost entirely in calculating the 10,000 step Black-Scholes tree prices. The rest of it in a matter of half of a second or less for 2,000 prices. All right, so that's all the questions that I see that we can answer right now. I thank you again for attending, and I hope you found this helpful.